listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA, and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for Options Playbook Radio, the program here on the old network, where we break down the sometimes scary, sometimes just overwhelming world of options into nice, easy to understand offensive and defensive plays that you can use in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting, at least we think so around here, and certainly ever necessary these days. You guys are all over us with questions and comments, so we thought it's a good day to dive into all of that. And, of course, to help me do just that, since it is his show, let me welcome on your regular host, the options guy himself, Mr. Brian Overby, a.k.a. the senior options analyst over there at Ally Invest. Mr. Overby, welcome back to your own program in these somewhat uncertain times, sir.
Oh, thank you so much, Mark, for would be willing to help me host the show today. As always, especially recently with the markets, we've got a lot of great listener questions and figured we had to get together and do a little huddle up and see how many we can answer.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, welcome to the Huddle. This is, of course, a portion of the show where you guys, the listeners, take the reins, your questions, your comments. We thought what better time than now to join you for a rare live edition. Getting Brian out there live, which is always fun. So you guys, if you have questions live, of course, we have a lot of them already sent in, but if you have some more, we can always try to squeeze some of those, and you know where to get us via the Mixlr feed and, of course, via all the major social media platforms as well if you want to get those in quick. We'll favor the live, so if you have some coming in, we'll try to bump them up, but we already have a good stack, so let's get to it. Let's set the table here, too. Of course, we are recording this episode and streaming it live of Options Playbook Radio here towards the end of March 25th to be precise. We're coming on the heels of a historic week for all the wrong reasons last week in the marketplace, where we saw the S&P moving successive sessions over almost 5%, about 4.8% in about 8 sessions in a row. The first time we've seen that since pretty much 1929. So you have to go all the way back to pretty much the early days of the Great Depression to see similar levels. Of course, we've seen VIX closing at or near historic levels not too long ago as well. We are in unprecedented times from an overall options and indeed financial markets perspective, as for the first time ever, the entire marketplace fully electronic. So not just options, even though that's a lot of options, that means your SPX and your Eurodollars and things that have a legacy pit presence are now entirely options, but also we're seeing equities and everything else. NYSE shuttering its trading floor. So it's just unprecedented times on top of the volatility, on top of the coronavirus fears. There's a lot to unpack there. And of course, now coming into this week, we are on the heels now of this new stimulus bill, which effectively dwarfs just about any other government intervention measure you could think of. Just let's think back to the New Deal, for example, a pretty historic measure, and that adjusted for inflation around $800 billion in net outlay. We're talking $2 trillion for this most recent stimulus plan here, and so just historic by just about any measure. What we're looking at here yesterday, of course, was the mother of all rallies. S&P up about 9.5%, and most of the other major indices following suit. Today, we saw a decent rally out there, but then it started to fade towards the end of the day as people started to digest the stimulus and perhaps uncork some issues with it. NASDAQ actually closing off on the day, off about 0.5%. The S&P up about a little over 1%, and the Dow up a little over 2%, about 2.4%. Which brings us to you guys now. And first thing I want to mention, you guys have been chiming in. We put this live not that long before the show here, and you guys are already flocking in. We asked you, hey, S&P has rallied north of 2,400 now. So quite simply, where do you think it's going to close at the end of the week? Above or below 2,400? AKA, is this real? Is this movement real? Or is it going to be a bit of a dead cat bounce? So far, at least coming into showtime, we had 73% of you saying this is the dead cat bounce, and about 17% saying this is real, and almost 10%, 9.7% says, who cares? I'm in cash. I'm safe. So it's hard to argue with some of the latter of that out there right now, given how mad things are out there. But Brian, that's a lot of table setting because it's a pretty extensive table to be set right now. But before we get into the listeners, really quickly, walk us through what these times are like for you over there at Ally. Obviously, you're running everything from a remote location right now, so you're social distancing like all the rest of us are. And your thoughts on what we're seeing out there from an overall volatility perspective, from a market price action perspective, from a liquidity perspective. There's a lot of different ways you can cut it up there, Brian. So what is really on your radar right now?
Well, yeah, it's all there. What the biggest thing I think is on the radar is the fact that we're coming into earnings season. We have a couple of stocks that have kind of, they're trickling in right now. We're not getting into the heart of it. The heart of it's going to be the beginning of April. But we are starting to see some earnings. And I think that we have an extremely volatile marketplace right now. And that's not even including earnings. Like the other day, I was just looking at Apple, and Apple was trading about 80% implied volatility. Their normal earnings implied volatility is about 40, 45, maybe 50%. So you're looking at volatility above and beyond even earnings reports in general on most of these stocks. And that's a good solid stock like Apple, and one of the sweethearts of the marketplace overall. But now volatility in general, I think I go back to 2008. I was taught a lesson in 2008 that high volatility can go higher. And one of the big numbers that we saw as far as the markets, and actually we mentioned it on our stock play of the day, myself and Lindsay Bell from Ally Invest were talking, and that we had an unprecedented move when we saw the VIX go above 50% implied volatility, which it really hasn't done since the 2008 crisis that we had. And at the same time, we broke through the October low, which was the beginning of the bull market. The October 20, going all the way back to 2009, that October low, when we broke through that and broke up on the VIX, in my mind, that was a sign that volatility was going higher overall. And in other words, it was a no holds bar situation as far as what's going to happen next. And we did see volatility skyrocket up above to the same levels that we saw in 2008. Now we're getting a little bit, now nothing is surprising anybody anymore. And I think that's one of the other takeaways here is that if we get the movement, the panic has already set in, and we had that big move to the downside on a lot of big name stocks. But I think people are getting used to it a little bit more now. And I would expect the VIX to come back down a little bit. But until the VIX gets back below that 50 level, I think it's a no-hold bar. I think that is a big level in the VIX index just in general. And as long as we're staying up around 60 handles in the VIX, implied volatility index, who knows what's going to happen next.
Let's see what our listeners have in store for us. A lot of you are still chiming in on this poll question. Let's just read a few of your comments here. I just like this handle. Sasquatch Blood. Sasquatch Blood says, I'll venture to say this is the mother of all dead cats. It's hard to argue with that, given everything else we've seen and how the worm is even turning already. Today, we were saying something similar not too long ago on the Advisors Option Program. Look for that hitting the network soon, listeners. Late stage, good handles today. Late stage capitalism saying it's a guaranteed dead cat bounce. We still haven't prevented the spread of the virus in the U.S. Again, hard to take issue with that. And Lyndon saying, end the poll now, dead cat bounce just one. Well, not quite. We're still over 2,400 there in the S&P, and we have it going for another day and change, so you guys still have time to get in. It's only been live for a little bit. So get on out there if you haven't already at Options. Make your voice heard, just like some of the rest of our listeners here who are chiming in. They also, of course, can send these go to the Options Playbook website and get these in, or send them directly to Brian. He gets these questions a lot as well. We want to make sure you can hit him up a lot faster. He'll get his questions a lot faster than if you wait for episodes of OPR where Brian and I get together to answer your questions. Even though right now, given the way things are, maybe we'll do some more of these for you. Let's kick it off here. Jeff Westmoreland. Hi, Brian. I recently purchased your book, The Options Playbook, from Amazon. That is how I found out about Ally Invest. I love the book so far. I really like your laid-back attitude and your sense of humor. Well, there you go. You got a good fan here, Brian and Jeff. He goes on to write, as I am new to options, what is a good strategy for knowing the best time to sell a profitable in-the-money call option? Obviously, if I believe the equity price will continue to rise, it may be good to continue to hold the call option, but at the same time, you are losing extrinsic time value on the option. Do you have a strategy to catch the option time to sell? Easy for me to say today. Talking a lot. Do you have a strategy to catch the optimum time to sell or close a call option as the call option intrinsic value is going up, but the time-related extrinsic value is going down? Any advice or direction is appreciated. Thank you, Jeff Westmoreland. Well, Brian, this is interesting. First off, you got to love the love there from the listeners. A lot of them have been flocking out to the book. You can, of course, get the Options Playbook in your hot little hands. Just search for Options Playbook over there on Amazon. You can get the digital version, the Kindle version as well. So if you want to sit down and actually read these plays for yourself and see the graphs, pricing them out, all that stuff, Options Playbook is what to look for on Amazon. Or go to optionsplaybook.com. That's also a place you can see it all broken out for you there as well if you prefer an online version of that. But Brian, people, they want to have their cake and they want to eat it too these days. They want to have the upside. They want to get that meat. So it sounds like he's trading one of your fig leaves or related stock substitution type play because he's buying an in-the-money call option. But then he also wants to catch it right at that right moment, right, where he gets enough of that move that he makes money on it, but he hasn't waited too long where that time decay really starts to kick in and starts to erode the remaining extrinsic value on this option. So, Brian, what do you have to say here for our buddy Jeff, who's clearly a big fan of yours, sir?
Well, yeah, thank you, Jeff. First of all, for the kind words. It's much appreciated. Overall, if I'm looking at this trade, one of the things that a lot of people kind of the way I like to look at it is I want to take some money off the table. And the simplest thing to do is to just roll into a call spread. So in other words, I'm not necessarily a big fan of if I'm thinking about doing a long call spread of legging into it, but if I have a profitable trade and I think there may be some more upside in that, let's do an example using the stock from that we talked about. Overall, let's just pick Microsoft. Let's pick one. 146 is where that stock is at this point in time where we're talking. Let's say we bought the 140 call. It's now in the money about $6, and maybe I sell the 150 call against it now. The stock has moved up enough that I'm feeling comfortable about the trade. I can bring in some capital and say, all right, I'll take some of the money off of the table. I got a little bit of profit, but I'm going to give myself some more upside. So now I've turned that position into, oh, gee, I better get out because time decay is hurting against me, and then think to myself, well, I don't mind sticking around anymore because on a long call spread, you're usually going to max out if your target price gets hit, which would be your short call, and it happens closer to the expiration date. So that's one way that you can look at doing the trade. Now, another way, if you just really want to stay bullish to it, I've had a lot of my clients do this over time, is you just keep rolling. Once you get to a point where, and I'm going to pick an arbitrary number, but it's not not a bad number, but where the delta gets to 80 or 90, in that scenario where I still have a little bit of time premium left. Usually if the delta is high, you're going to be more intrinsic value than time value, and you just roll to a 50 delta or you roll to a 40 delta. You can pick that expiration if you'd like to, but that way too, I'm taking some profits off the table, and then I'm using it to buy another option contract that will allow me to participate on the upside. So one way when I'm thinking about rolling, if that's the case, a lot of times I want to sell and make enough money where I get my money back, and now I'm just playing with the house's money as I roll to a further out in time, usually up in strike option contract that will still give me some more upside. So those are two of the strategies that we do. I lean towards the call spread, rolling into the call spread, but I have to emphasize you have to be approved to be able to do spreads. If you're approved to only buy option contracts in your brokerage account, then legging into a long call spread or a bull call spread in this scenario may not be allowed. So you just got to make sure. And if that's the case, usually you just got to update your option app. They'll usually give you that type of approval. It's not that hard to get. So that said, back to you, Mark.
Yeah, I like both of those suggestions. The time spread is good. I'm also okay with them just closing it out. And a couple of assumptions for a strategy, a trade like this. If he's following the playbook, then he's going out a few months with his in-the-money call. He's not just buying an in-the-money call. Hopefully a few weeks to go. He's given himself a little bit of time for this strategy to play out. Spoiler alert, going to talk about something similar, at least you are, Brian, on Options Playbook Radio coming out tomorrow. We're talking about Microsoft and stock substitution type trade, and that's exactly what this is. This is a stock substitution type trade as well. The good thing about it is it's mostly intrinsic value, right? So you're not going to get hurt a lot by theta. So that's one of the nice things about it. But if you have a little bit of extra theta on there, or extra extrinsic value, you're worried about keeping as a certain point, as you mentioned, Brian, I think that delta is a good way to do it. That's going to measure how close you're getting to expiration. Obviously, that theta is going to accelerate as you get closer to expiration as well. The key is you don't want to hold this thing all the way until the options go away. If you're doing this, let's say 3 to 6 months out, and you start getting within that front month time frame, you definitely probably want to get rid of this thing and probably roll it, as you said. Get yourself a little bit farther out. Get yourself a little bit farther away from that time decay. Because at that point, then you are watching it erode every day, even if the stock is kind of just sitting there, and that could certainly be demoralizing at the very least to someone who's new to options, like he says. I think your ideas of the call spread or the vertical or rolling, I like the rolling, actually. I think if you want to keep this bad boy alive, if you think this has already peaked out the move, then just close it out. People are always, for some reason, so afraid to close these positions, Brian. I don't know why that is. We get so many questions along this vein of how can I get rid of this without closing it? And it's okay to close it if you think this thing has run its course. So that's certainly one to look at, too. And definitely don't hold this all the way in to expiration. That's when you're going to see theta really start to take its toll, and you've already had a good run. Don't lose some of it just because you're stubborn. The old saying, people see us on the short premium side, but it works on the long premium side too. Pigs get fed, hogs get slaughtered. Take what you got, take it off, go on to the next thing. Don't sit there waiting to the last minute, because that's going to cost you in this case. All right, next up, Jay Jones. Hi, Brian. I love the work you do with the OPR podcast. Man, the love for Brian just flowing in here today. He said, I generally trade for credit, either vertical spreads or iron condors. My question for you today is, what is the benefit to trading a pure call or put condor versus an iron condor? The risk-reward profiles at expiration are identical, but it seems like theta decay doesn't help the call condor or the put condor as much as it helps the iron condor. Can you give me an example or discuss when the call condor or the put condor makes more sense than the iron condor? Thanks so much. Keep up the great work. All right, interesting stuff here, a little table setting probably for this one as well. Your traditional iron condor. If you're not familiar, listeners, first off, you need to go check out the Options Playbook or optionsplaybook.com or some of the early episodes of Options Playbook Radio where Brian breaks down all these positions in a lot of great detail. But the iron condor, effectively an out-of-the-money strangle on both sides, puts and calls. And that's what he's talking about. And what he's referring to is let's play with that a little bit, instead doing all of them in the puts or all of them in the calls. And what are some of the benefits or downsides, or are there any? Brian, is this an approach you like to take very often? And if so, what is your use case for flipping the script on an iron condor and going all calls or all puts, sir?
All right. So in general, the iron condor is the more popular strategy of them all. And I think that Jay Jones is highlighting that right now in that most people seem to want to do the iron condor. And I think one of the biggest things about the iron condor is that if you do an iron condor, what you're doing is you're selling a out of the money call credit spread, and you're selling an out of the money put credit spread. This means that we're dealing with lower price option contracts. And when you usually have lower price option contracts, in general, the markets are a little bit tighter. So when I do that trade and I want to trade out of one position, either because it's gone against me or it's gone with me, usually I get a little bit tighter markets, a little bit easier executions just overall. Not to mention the fact that if I am correct on my iron condor, I'm selling a call credit spread, selling a put credit spread. Those options expire worthless, and I get to keep the net credit. So in that instance, I don't have to sell anything. I don't have to deal with any markets at all because the options expire worthless, and that's the best case scenario with an iron condor. Now, if I look at the call condor and I look at the put condor, I still have the same forecast. I want the stock to stay in the middle. But a call condor, and that's the only one that I'll focus on to finish this thought, means that I'm buying an in-the-money long call spread and I'm selling an out-of-the-money short put spread. Now, that in-the-money option contract, especially like getting into it, that's not that big of a deal. If I'm getting into the position, I can work it a little easier. But if it goes against me, I'm dealing with more expensive option contracts. Both of those option contracts would be in the money, with a little bit wider bid-ask spreads. If I'm correct on my forecast, I still have to close out the call side, or I have to get exercised and assigned on the call side. So overall, most people are going to do the iron condor, and I'm just going to lean to that. But it's mainly because of the markets than the fact that you're dealing with lower price option contracts, and you can usually get better fills. You have tighter markets on it. So I don't know necessarily where there is a scenario, and I'll leave it up to Mark to try to come up with one. But I would always prefer to do the iron condor on a neutral outlook in the marketplace, much more than the call condor or the put condor. But with that said, any thoughts on that overall, Mark?
This is why I love opening up to the listeners, because they always throw a curveball, right? And this is, I like I said, an iron condor. People listen to the network know I'm much more of an iron fly guy than an iron condor. I like to get really close. If you're going to do it, this the old saying, go big or go home. I used to have a co-host on my volatility views, so I used to say, iron condors are iron butterflies for cowards. I always liked that expression, just because the iron butterfly, obviously an at-the-money straddle versus an out-of-the-money strangle, as opposed to two out-of-the-money strangles. One's obviously much closer to the fire, going to swing a lot, move a lot more, also going to suffer a lot more from decay. So it's a much riskier strategy, so you have to have a little bit higher risk tolerance for it. But it's also going to perform better in crazy markets than an iron condor. Iron condor, the plus side is you get a little bit more cushion. If you're a little bit uncertain as to which way things are going to happen, or maybe you want a little bit more wiggle room in that, then the iron condor is a good choice. So I'm much more of an iron fly guy to begin with, and I'm trying to think. Yeah, I've never had any reason that I could think of to say, I really want to mix this up and go in for all calls or all puts. It's just not a use case I've ever had or ever wanted. It doesn't really, I guess from a utility perspective, I just don't see a reason to do it. So sorry to Jay, Brian and I, not exactly fans of, if you like the iron condor, if it's working for you, stick with what brought you to the dance. You don't need to mix it up. Live folks chiming in here. Brian, your head's going to get big after this live show. So I'm just worried about that. We got a live comment here from Charlie. He says, great to see Brian live. We need it now more than ever. There you go, Brian. You're the man we need now more than ever. What do you think?
Well, that's coming from Charlie. I appreciate that, Charlie. It is unprecedented times, and we do need to just not panic as much as we can and just stick to our guns here. And that's one of the things that option trading can help. This market is set up for, if you're not trading options now as an option trader, then I don't know if you can call yourself an option trader overall. So I'll leave it there, Charlie.
I like that. That's a good quote. We'll have to put that out here. Producers listening to the show, tweet that out. I like that. If you're not trading options now, then you can't really call yourself an options trader. I like that. Interesting stuff. Who we got here? Oh, yeah, another live one. This is kind of dovetailing on what you, spoiler alert, going behind the scenes here, breaking the fourth wall, Brian, what you already just recorded for tomorrow's episode of OPR, but we can touch on it a little bit. This comes from the creatively named LL5$6. I love some of these handles. It says, are you guys fans of stock substitution here, and how far out? I'm assuming he means how far out in time. And yeah, spoiler alert, yeah, that's a strategy we've extolled, and Brian has extolled quite a bit here on the old options playbook. In fact, that's one of his go-tos. I've often teased him about the naming convention of the playbook, of the fig leaf, which is a stock substitution with effectively what can loosely be termed a synthetic or a quasi-covered call end on the front end, where you're trying to finance that stock substitution a little bit. And that methodology is one I think we're all fans of here. And again, I don't want to step on Brian's toes because he just did a whole pretty much OPR just about this topic. But Brian, I'll let you, again, you don't have to spoil your episode for tomorrow, but if you want to get into your thoughts on stock substitution and right now, how useful it is right now, and also in general, when you like to set these up, how far out you like to go, have at it, sir.
All right. I am a fan of the stock substitution as an alternative. And as a matter of fact, I am going to mention on the show tomorrow, but we talked about this going into the new year on Options Playbook Radio as one of the things to think about with all the gains that we had in the stocks, because you're limiting your downside to the cost of that option contract. Now, it's usually a fairly decent sized downside on it, but overall, what we're doing here is you're still limiting to what it might be. And if you think about it right now, if you're limiting it to 15, 20% of the real stock price, a couple of months ago, that sounded like a pretty good limit at this point in time. But, you go all the way back to December, that wasn't quite as exciting. But how far out do you go? The one thing that I would pay attention to is earnings. We're coming into earnings season, and so I don't want to be buying these during the months that earnings are being announced, but I'm going to think about doing these where you're anticipating that this crisis might subside a little bit. So going out to the summer months, June, July, August, those are decent time frames to look at, but I'm going to go out a little bit further in time. I want to make sure that I own enough time to let things play out the way that they are. I'm going to avoid anything where there's earnings. I don't want to be buying these expirations that have the earnings announcement in them. So I'm going to be cognizant of that. But excellent opportunity here to try to dip your toe in the water and not spend all of the cash up front. You're looking at spending maybe 20, 25% of the capital of buying the stock outright. You should be getting about an 75, 80 delta for that. So you're getting something that really acts like the stock. And I'll just say tune in tomorrow to talk in great detail about a stock substitute plan in Microsoft. Yep.
Yeah, check out that one. Will be hitting the network tomorrow. It's fresh off the recording presses, so you'll be getting it there tomorrow. And yeah, this is the strategy, as Brian kind of alluded to. You want to give yourself some time. So I can't really count anything as a stock substitution if it's less than 3 months. I just don't like that time. You got to give yourself 3, preferably, or maybe around 6, if not more. And you have to do that delicate dance. Obviously, if you get too far out, then you're starting to overpay. Of course, that extrinsic value starts to grow a little bit as well. So you want to do a delicate dance. That's why I think, again, that's, as Brian has mentioned, you need the earnings and all your outlook. All these things have to factor into what the appropriate time horizon. I can't say you have to do 7 months every time. It usually falls somewhere in that 6 months, I think, to 1 year time frame is the best type of time horizon for this, and that gives you time. Obviously, below 3 months, you're starting to get impacted by what that listener asked about earlier, which is that theta can impact you and really start to negatively impact your returns. You want to stay away from that, hence beyond 3 months. And then you also don't want to go too far out. So I think 6 months to a year. Typically, I want to say at least 65 delta, probably 65 to 85, probably more like a 70 to 85 is a realistic kind of delta threshold for where you want to kind of be playing. You want to get a meaty contract. Beyond that, beyond 80, 85, you're starting to get pretty pricey. But below that, you're not going to get the bang for your buck either. So it's, again, depends on the outlook, on the underlying, on your time horizon, what's going on, all those things. But general rule of thumb, I like it somewhere in the 6 months to a year, somewhere in, let's say, 65 to 80, 85 delta or so. I think is a pretty common starting point, and then we can kind of narrow it down once you start talking about your underlyings and everything else like that. All right, next up, Brian, everybody's got this question these days. It's kind of hard to argue with why they have this, but they all have it on the brain. Well, I'll just list a couple here. We got many more of this exact same question. Mike Wienick, he wanted to know if markets are shut down due to the extraordinary circumstances and I have expiring in the money puts that I bought, what happens? Are the expiring options automatically exercised, or are they due? I think you meant, do they just expire worthless because the market was shut down? Similar question here from NNJ66. What happens if the stock is halted or exchanges are shut down? When I own puts, everybody and their mother has this exact same question. And what I typically recommend times like this, you have a question about a structural issue with an option like this, you go to OCC, Options Clearing Corp. That's the place that has information. As it just so happens, I think they realized they were getting this question a lot themselves because just about, not even a week ago, they put out their unscheduled markets closing guide. I encourage everyone over there who has this question, and it seems like there's a lot of you, head on over to the OCC or just type OCC unscheduled market closings guide, plural. You'll find this, and it details all the different scenarios and what they're going to do in each of these. So if you have questions about these, that's the first place I would start. That said, Brian, I'm sure you've had these questions from clients before. It has happened in some obscure scenarios. We've had shutdowns, 9/11, obviously other times like that where exogenous shocks to the market shut things down. What do you counsel to your clients over there at Ally in times like that, sir?
Well, in general, they're not going to expire worthless if they halted in the money. In other words, as long as that stock is considered in the money, they would exercise on your behalf. But it is a risk to you overall in that you don't know where the market's going to open up at. So even though they might expire and they exercise on your behalf, where the stock opens and where you can get out of that stock position in puts scenario, you're going to be short to stock. Where that opens might actually erase some of the gains that you had because you didn't close that position before you got to, let me say that again. In other words, if I did not close the position on the market and I was exercised and I got short, I still have market risk from where the stock is moving. There's just not much you can do about it. You have to take what the market gives you in that scenario. So it is a scary concept overall, but I would definitely refer, before I get myself too far down the rabbit hole, I would refer to the unscheduled market closing guide that the OCC put out, for sure.
Yep, that's the first and hopefully the last place you have to go for that sort of information. But you're right, that option doesn't go away. It still will. That's the nice thing about having an option. It is a guaranteed contract. OCC is there to backstop it for you. So if you think something's going to happen where the underlying is going to, when they eventually do reopen, let's say in this case you have puts, you think it's going to open well below where things got halted, you can still exercise that even though things are halted. You can't go in and close it out and sell it, but you can exercise it. So that's something to keep in mind as well. You always have that right out there. So you can contact them, contact your broker and say, hey, I want to exercise this now before the contract expires. And obviously when the underlying reopens, that could be beneficial to have a short position as it's dropping or a price lower than where you have it right now. So something to keep in mind, that option, you still have that quote-unquote option there to exercise it even when things are halted. But again, that guide's going to walk you through all of that, so check it out. All right, Brian, we're kind of coming up against, so let's see if we can squeeze in a few more. The people are needy these days here. Let's go to this one. This guy wrote in not that long after our last huddle, Brian, so he's been waiting patiently. In fact, I think we talked about his question on another show just to make sure people don't have to wait too long for their questions. But I want to get it answered on his mothership show, the one he sent it into. And also, everybody loves and or hates talking about Tesla, but again, they all have questions about it. This comes from Olado Negro, and he or she writes, can you please tell me why Tesla put options on the $920? This shows how he sent it in about a month ago. Tesla, a little bit different price level now. Expiration on February 21st, almost exactly a month ago, didn't increase the value. I think I'm going to go out on a limb and say English not his first language, but he's doing good here. Didn't increase the value as the stock plunges today at 11:20 a.m. Actually, they drop a little more as the stock was falling, only really to start increasing in price after the stock broke its VWAPs, or its value-weighted average price, listeners. So, Brian, we don't usually get the question with this flavor. Usually it's the other way around. Usually it's, hey, I bought a call ahead of earnings and the stock rallied after earnings and I lost $5 on my call, something like that. He's asking the other side of this question, which is he bought a put and it moved his way, and yet it didn't work out in his favor. What do you have to say to Olado Negro? And I'm guessing a few others who have this question right now, maybe not just about Tesla, but about a bunch of names out there. Maybe they're paying a little bit higher vol than perhaps they need to. What do you have to say for these folks out there, Brian?
Well, this is such a tough one. And in Tesla, just even before the market downturn overall, you're trading volatility as much as you are trading the actual stock in general. And Tesla at one point in time, I don't know if they still are. I doubt in this marketplace that they are, but they were the biggest short interest in the marketplace for many, many months. And when that happens, there gets to be usually a huge skew in the volatility. And now here's what I'm going to I'm just going to paraphrase here. I don't have a chain of Tesla options up at this point in time, but your at the money volatility, you might be paying 100% implied volatility, but you go way out of the money in Tesla and you're paying 200% implied volatility. In other words, the market knows that people want to buy some puts in this underlying, and because of that, and because of how many shares of the stock have been shorted already and stuff like that, it drives up the put prices relative to the call prices overall. As far as out of the money, so if I'm 100 points out of the money on the put side, I'm trading at a much higher value than 100 points out of the money on the call side. So why did this happen to you? Because the world's not fair, I guess, in some instances, and this is one of those. The market comes down, and the implied volatility, the at the money, now all of a sudden that option contract becomes more at the money. The implied volatility skew goes back towards the at the money option contract, and the price of the option contract just stays the same. I don't have a good answer for it. It's a sad thing, but that one's even tougher, because usually when you're talking about it on the call side, as Mark mentioned, it happens because of an event, because there's a known event like earnings. You get the earnings right, the market goes up, all that vol premium comes out, and the call option just doesn't pay you what you think it is. But this is the scenario specifically when you're trading in stocks that are leading the market in short interest. And that's really what Tesla was at this point in time when this was happening.
Yeah, you're right. It's a sad one, Brian. We don't like to see it because he was right in his outlook, just not in his time frame, obviously. A few weeks or certainly a month later, those 920 puts are looking pretty good. But you're right, Tesla's a weird name. Not only is it short restricted, so that's going to give an extra juice to these puts, which if you're buying these, it's going to make it harder for them to pay off. But also, of course, it's like every day is an event in Tesla. You don't need an earnings. Every day that ends in Y is a different event risk. So they're pricing in just extraordinary levels of volatility. And if it's not moving enough to meet that on top of the extra premium you're paying because everyone's trying to get short, so they're bidding up these puts, it's kind of a double whammy in Tesla. It has to move a lot. That's the thing. We always say you can't just buy an option and expect it goes your way. It has to work. You have to consider the volatility level that you're paying. And in this case, you don't mention what it was, but I'll go back and check for you. But it was high. And clearly it wasn't enough. And that's what happens. If you don't get enough of a movement to warrant that volatility level, even if you're right in direction, you weren't right enough to overcome the loss of all that volatility getting sucked out of that like a balloon. So that's unfortunately what happens. And speaking of unfortunately, that music means we come to the end of this epic live huddle. I think this was fun. I'm going to see if I can twist Brian's arm and get him to do some more of these live ones, because I like them. I know you guys like them. And certainly in these crazy times, we need some sanity out there, people to talk us off the ledge. So these are fun. We're going to hope to do some more. But Brian, before we go, if folks want to participate on future huddles, or maybe they don't want to wait that long, they don't want to wait as long as Olado Negro, they want to get at you instantly, where should they go? What should they do, sir?
Well, they can always send me a question directly to my inbox at theoptionsguy@invest.la.com. Mark, thanks to you for hosting. Everybody out there, thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.